Hello again. This is Professor Hazara recording from his house once again. This is the third in the series of, it looks like it's going to be 4 or 5 videos involving how to make full pro forma financial statement based valuations. Okay, let's go back to, now we can actually go back to the screen we stopped at last time. Okay, at the end of video number 2, we had done what I call setup. The setup of the financial statements. And this was basically a routine for getting all the elements in place to make a full set of pro forma financial statements. Let's just go over where we finished last time, and then I'm going to get into this very quickly because this is the video which can be really quite involved. Okay, we have super growth. We're using a 2-stage model. We have a super growth model. 7% growth rate, cost of capital 4%, constant growth period, growth rate of 1%, and cost of capital 3%. Okay, more importantly, we had just started our income statement, and both the income statement and the balance sheet below, as you saw it, were made up of obviously all the different line items, percentage. All of these are a percentage of sales. We went over that last time. And then our base year. All these numbers here for our base year, both in the income statement and the balance sheet, were obtained by cutting and pasting from the income statement on the 10K. The income statement will be way out here. So it was the latest year was 2019. So we cut and paste. Our base year for the income statement was 2019, as it is for the balance sheet. Okay, I'm going to get right into this because this one takes a little bit of a long time. Now, I had finished the last video by saying there's basically 2 ways. It'll turn out to be 3, but the third one is very easy. So there's going to be basically 2 ways that we're going to make the line items on the pro forma financial statements. One is what I called the base formula. And this one is very important because what we're going to be able to do for individual line items, not for subtotals, but for individual line items, all we're going to have to do is take this base formula and copy it to that line item, and it will get us a series of amounts which are equal to 14% or whatever percent of that respective year's total sales. And the second, so that's the first way we're going to make some of the line items. The second way are simply subtotals. As I said at the end of last video, is if you make pro formas, subtotals have to be subtotals. Now this is going to take a while, but if you remember those 2 things, that individual line items, all we're going to have to do is cut and paste for the most part this base formula, and you can do it using any one of the line items for which we use the base formula, or by using subtotals. That's at least 80% of the game. The third way you'll see is very easy. There's some line items that we're just going to assume they don't change, and so they'll be flat. That's rule number 3 basically. But so anyway, let's get going. Okay, so we have a company. Let's look at 2020. With 15,630 in sales, about 8,800 is your cost of goods sold. So this is a subtotal, and you'll notice the formula for gross profit is sales less cost of goods sold. We'll give you your gross profit. Okay, now going down beneath here, we see 3 items which are not subtotals. That's research and development, marketing and selling, and general and administrative. Those 3 items make up 14%, 4%, and 3% of sales, respectively. Okay, so all we're going to have to do, and this is why this base formula concept is so important, is take this base formula here, and you copy it, and if you paste it for those 3 items, for research and development, marketing and selling, and general and administrative, you will get the correct numbers. And I'm going to take the lines out of, I'm going to reformat this, take the lines out of those right there. But what you're getting here are the amounts for each of these items that are equal to 14% of that respective year's sales for research and development. Same holds true for marketing and selling. Each one of these line items is going to be equal to 4% of their respective year's sales. And finally, that's true also for general and administrative. Each one of these line items is going to be 3% of each year's respective sales. So, turning up the audio here a bit for you. Okay, so we've already completed just by copying this formula down. You'll see that all these other rows here are basically the same formula adjusted for the rows, basically. Okay, but the importance of this is it makes your job much easier. Once you have your base formula for individual line items, not subtotals, what you then have to do is just use the base formula and cut and paste down. It makes your life a lot easier. Okay, now we've got two subtotals. This first subtotal is your total operating expenses, and the next one is going to be income from operations. Okay, your total operating expenses is a subtotal. And like I keep repeating, when you make subtotals, they've got to be subtotals. You cannot be just using the base formula for subtotals. So let's do this. Total operating expenses are equal to the last three items: research and development, marketing and selling, and general and administrative. Okay, so if we sum those items up, our total operating expenses for 2020 is $32,428. Our total, or excuse me, $3,248. Our total operating expenses for 2020. Okay, now all we've got to do, obviously, is copy that across, and we'll get our total operating expenses for 2020 through 2024. Okay, now we come to income from operations. Now, income from operations, as you could guess, is simply the gross profit, the company's gross profit less the total. So it's going to be gross profit, which is right there, less your total operating expenses, which we've just summed. So in this case, it's D14 less D19. So there's your income from operations. And I'm going to go ahead and put a line underneath total operating expenses to indicate that the next number, the total income from operations, is a subtotal there. Okay, so obviously, in order to get income from operations for the rest of these years, all you need to do is go across, and you should get those numbers right there. So income from operations for the year 2020 are $35.84, and then for the final year there for 2024, it is $46.98. Okay, now we're almost finished here. Okay, and I'm scrolling down. I almost feel like I could start splitting the window up, but that can actually cause confusion, believe it or not. Now we've got our income from operations. So income's getting lower and lower because we're taking out more expenses. Okay, now we've got two items that follow income from operations. The first one is interest expense. That one's obviously going to be deducted because it's an expense. Okay, and then we've got this item here, which is interest and other income. This is going to be added because it is other income. This actually comes very close to the income statement format that I believe the intermediate books have in them, is you separate out all the operating items from the financing items, which are interest expense and interest income. Okay, so let's see. And here's what I'm going to do. I'm going to assume, because they're so small anyway, I'm going to assume that these don't change. Now, that could be a bad assumption. I'm telling you, I know that. But at least for now, to get started, let's assume they don't change. So what I'm going to do is I'm just going to assume that these are flat. And I'm also going to assume that interest and other income, we don't even know what's in there, what other income is, probably some type of financing income, we're going to assume that's also flat. And the reason that we can assume that's flat is because, first of all, we really don't know what's in interest and other income, but and so we'd have to do some investigation. But the other reason for this is that these are financing items. They really are not a function of sales. Interest expense and interest income are not a function of sales. They're a function of how much debt you've taken out and how much you've loaned to other companies, respectively, interest expense and interest income. So making them flat, at least for now, is a reasonable assumption. Okay, so let's go over. What I want to do is go over, we'll finish this first, and I want to go over each line on this statement to summarize how we came up with each line, either using the base formula or a subtotal. Okay, so here we have income from operations, and we're going to subtract out interest expense and interest income to come to our income before taxes. Let's go ahead and put a line right here to emphasize that that is a subtotal. The next number is a subtotal. Okay, and our income before taxes is going to be equal to the following. It's going to be equal to income from operations minus, very important, minus the interest expense, because the company made a 10K without pluses and minuses, which is quite common. So you've got to kind of figure it out for yourself, but it's an expense. So it's minus interest expense plus interest and other income. So what we have here is our final, I'm going to clean it up here for a little bit, our final income before taxes for the first year for 2020 was $3,504. Okay, and so obviously it's a subtotal, so all we've got to do is take this subtotal and bring it across here, and you see right here that the income for this company grows, but it doesn't grow as much as a lot of other companies, such as Apple and other companies we've looked at, even Texas Instruments. Okay, so we've got, that's income, that's your income before income taxes. Okay, so now we've got to take out our provision for income taxes. So we've got our provision for income taxes, and so we're going to get our net income. Now, this is very important, and I will go through it a little bit later on. Okay, but rather than computing a tax rate and all those things, I'm just going to compute the provision for taxes as a percentage of sales, and there's a degree of reasonableness there because obviously the greater your sales, the greater your income taxes. There's other ways to do this, but just to keep this straightforward, I'm just going to do it as percentage of credit sales. So all I need to do, since it's a line item based on a percentage, I can go to any one of these lines. I'm going to use this original one. It's based on the base formula, and just go ahead and copy it all the way down to provision for income taxes, and that'll give me my tax expense for each one of these years. Now, is it reasonable? That's something you'd have to do as you develop the model further. Okay, so here's what we got. We've got income before taxes, that's a subtotal, obviously, of 3504, and it grows to 4618 by the last year. Now, obviously, we're going to subtract out your income taxes to get a net income. Now, it's very important. I have net income is 19%, but we all know that net income is the ultimate subtotal. So let's do this. Let's make sure to get this out here. So your net income is going to be income before taxes minus your provision for income taxes. Your net income for the first year we're looking at is $2,901. And we're going to copy across there. And so those are our net incomes. And I'm going to go ahead and bold this entire line here just to emphasize that. Whether you do it or not, it's up to you. Okay, and I'm also going to double underline it to emphasize that this is our bottom line number. This is our income for each one of these years. Okay, now I'm going to go back here, and I'm just going to emphasize how I got each one of these line items, the research and development, et cetera, et cetera, et cetera. I got these three expenses, research and development, marketing and selling, and G&A, just by copying the base formula. So just to give you something as a reminder, I'm going to say those were derived from the base formula. All I did was copy that formula once I get it down to those, and I got those numbers. This was a subtotal. Obviously, operating expenses is a subtotal. Next, also, obviously, income from operations, that's a subtotal. Okay, now, interest expense and other income, I'm going to write in, those are flat. I just assumed that they wouldn't change because I really don't know how much debt they're going to issue. I really don't know that. You can make further models that make assumptions and make all sorts of what-if scenarios, but right now, just to keep it simple, I'm keeping those flat because they are not a percentage of sales. Okay, the income taxes I took out as the base formula, and finally, that was my income before taxes is a subtotal, and finally, my income taxes is. My provision for income taxes is based on that base formula. All you've got to do is take any one of these, which is based on the base formula, copy it down to any one of the other individual line items based on a percentage, and you've got it. However, the ultimate subtotal is your net income, which is right there. Okay, so that's your ultimate subtotal. So I'm just trying to summarize how I got each one of these things right here, and you can go back. Now, you notice that after, like all income statements, after net income, we have our earnings per share. And ultimately, it's very nice to have some idea of how you're projecting earnings per share. That's how the analysts do it. This is how they do it. They project income statements out to get earnings per share. It's obviously much more complex than this. They do a lot more. They're experts in individual industries, but this is how they're doing it. This is how they're changing. They change their models consistently, and their earnings go up or down, and that's what you're seeing in those analyst estimates. Now, I'm only going to calculate the estimates of basic earnings per share. I'll leave the diluted numbers in there, but I'm just going to worry about basic earnings per share. So basic earnings per share is obviously going to be equal to, net income divided by your shares. I do want to do one thing here. I'm just going to go ahead and assume that my shares are flat. I forgot to do that. I forgot to get my shares there. So it's easier now. Okay, let's assume that they don't issue any more shares. You're going to see something at the end where that's a good assumption. They actually do the reverse, apparently. But anyway, so your net income is 2,901 for the first year, which is 2020, divide by the number of shares, which is 937, and our earnings per share, our forecasted earnings per share for the year 2020 are $3.09. And here's what we're going to do. We're going to clean that up a little bit. And all we've got to do is, because it's basically a type of subtotal in a sense, and we've got our basic earnings per share right there, Okay, and I'm going to call that a subtotal once again. Okay, so anyway, so there's your income statement. Okay, it starts at 2024. Okay, there's your sales numbers, and everything here are dollars. So I may regret this, but I'm going to go ahead because I don't see anything that's not dollars, but through income, I'm going to go ahead and format it just to give it a little bit of flavor here, and then you can go back and look at it. So we'll format these cells for dollars. These are currencies. 0 decimal places just to make it simple, and we'll use the dollar obviously. And there are your numbers for the years. So, and keep in mind that there's the base formula and your subtotals, and they're all in millions, I believe. Okay, so that gives you right there, and we'll do the same thing, by the way. We'll do the same thing for earnings per share. And then we're on to the balance sheet, which can be kind of tricky. Okay, so there's your number right there, and we're just going to go ahead and reformat this for 2 decimal places So there's your earnings per share right there. So if you were an analyst, you start with this model, and then you'd be tweaking it based on world events and events with the company, estimating earnings per share up or estimating them down. Okay, so now here we come to the balance sheet. Okay, and I do think that for the balance sheet, well, I just want to scroll down and give you a final look at the income statement. That's what it looks like before I go on to the balance sheet. And I'm debating this, but I am going to split the window on the balance sheet. I'm going to split this window, okay, right here. So just so that you get a better view, the balance sheet is a little bit longer. No, actually, I can't do that because I've got to be taking formulas from up here. At least initially, I can't do it. Anyway, so let's go ahead and start the balance sheet. Okay, now the balance sheet it's not too complex, a balance sheet. We've got current assets, we've got cash, short-term investments, accounts receivable, and inventories. Those are all current assets. Now, on the balance sheet for current assets and current liabilities, like we did on the income statement, for all current items, we're going to assume that they are a consistent percentage of sales. That means that you can just use the base formula again. So you can come up here and use any number that is based on the base formula, and any row that's based on the base formula, and you can just copy it to any line item, and that's what we're going to assume for these four, any line items that are that we're assuming are a strict percentage of sales. So if you look at cash, short-term investments, accounts receivable, inventories, and other current assets, we're assuming that they're just 21% of sales. So all these numbers are 21% of sales. Short-term investments, that's iffy, I know, but they're small, and I want to keep this simple because of these videos. And so those are small. Accounts receivable, that's very reasonable to say they're a percentage of sales. And the most direct number are inventories. Inventories and sales, obviously, there's a direct number. Other current assets, you really don't know. Okay, anyway, so I'm going to go ahead and reformat these so that they're not underlined. Okay, so all of these right here, all these numbers right here are based, so to speak, on the base formula. All I did was took any row based on the base formula and copied it down. Okay, so I'm going to go ahead and make sure to at least mark these, and I'm just doing this for you to emphasize that these were just cut and pasted down. You didn't have to do anything else. Okay, now we come to total current assets, which is obviously a subtotal. Okay, total current assets are going to be made up. They're going to be made up, obviously. I could just sum these things, but I'm going to go ahead and go through each one. Cash plus short-term investments plus accounts receivable plus inventory plus other current assets. That gives me my total current assets for 2020 are 10,920, and coming over here, that ends with total current assets of 14,314. Okay, and I want to make sure to emphasize to you that that is obviously a subtotal. All subtotals must be subtotals, or later when you do what if analysis, the thing just falls apart. Okay, what do we do with long-term investments? I'm just going to assume that long-term investments are flat. And the reason is they don't necessarily have anything to do with sales. There could be some equity method investments in there. I just don't know. So if you don't know, it's the initial model, just keep it flat. If you know nothing about something, just keep it flat, and then you would investigate this thing in the footnotes, in analyst opinions, and that would be, then you'd find out some information and maybe change it on that. But for now, let's keep it like that. It does seem like they have some acquisitions though, but they're coming out in the consolidation. Okay, now here is the most important single line item there is. Property, plant, and equipment net. Okay, and I'm going to emphasize here, I must emphasize that property, plant, and equipment is always based on the base formula. And I'm going to put here always on the base formula. It is always based on the base formula, and you're going to see why in the next 1 or 2 videos. You're going to see that, and this is so important. I'm even going to make this large, or make it even larger. This is always based on the base formula. Okay, so it makes the calculation easy. All you've got to do is take any one of these numbers, the rows that are based on the base formula, and copy it down. But plant and equipment net, and I have to emphasize net, plant equipment net is always based on the base formula. And part of that, it has to do with when we get down to the bottom and start calculating our free cash flow, we've got to make all the numbers equal, and that's one of the things that gets numbers to equal. Okay, so now we've gotten through plant equipment net. We're working to finish the assets on this valuation. Okay, and so we've got plant equipment net of 1636. I'm just verifying some of these things here for the first year. So far we're perfect along with my calculation that I did before, obviously. Okay, now I'm going to assume, and this company has done some acquisition, obviously, and I remember that from the presentation class that they had specified, the group specified that they had done some acquisitions. And even though goodwill is a large number, I'm going to keep that flat. And you'd have to do some investigating on that, but I'm keeping goodwill and purchase technology and other intangible assets flat for now. You'd probably have to do something later on based on anticipated acquisitions, but let's just keep it flat for now to keep things simple. Okay, so I'm going to go ahead and specify that I am keeping these 2 items flat. Okay, now we're coming down to we're almost finished with the asset section. Okay, and deferred taxes. And I should have done this one too. I'm also going to assume, this is easy, I'm also going to assume that deferred taxes are flat. Okay, at 2031. Okay, so I'm just scrolling up and down here. So here's what we got for the balance sheet so far is we have total current assets, and let's go ahead and you don't have to do this, I'm just doing it. Total current assets are 70% of sales, and those are the numbers for total current assets right there. Our long-term investments are flat. Always, your property, plant, equipment is always right here, used as based on the base formula. So all these numbers here for net property, plant, equipment are 10% of sales. Your goodwill, I assumed, is flat, as I did for your purchase technology and other intangible assets, and as well as your deferred taxes. Okay, so let's go ahead, and obviously your total assets are a subtotal. So we're just going to go ahead and total. It's a subtotal, really in a sense a total, but it's a subtotal. We're going to go ahead and add up all the assets. Now your assets, I'll do this slowly, are going to be equal to obviously your total current assets plus your long-term investments plus your property, plant, and equipment plus your 3 intangibles plus your goodwill plus your purchase technology and plus your deferred income taxes. Okay, so I'm going to go ahead and check this. So your total assets at the end of the first year should be 19,845. And I'm just checking against the sheet that I have here, and that is correct. 19,845 are your total assets at the end of the first year, and then total up to the end of the second, to the end of the 5th year, and your ending total assets should come to 23,748. So far, we are right on track for this thing. Okay, and I'm going to go ahead and obviously, as I should, I'm going to go ahead and not only bold it but double underline it to say that's the left-hand side of your balance sheet. Okay, so here's your total assets, the left-hand side of your balance sheet. Okay, now we go down to liabilities. And I know that some of you might think it's nice if I split the window, but you'll see that I can't really do that when I get to the bottom of the balance sheet. Okay, which is why the basic equation is so important. Okay, so I'm going to assume that any current liabilities, we have three. We have current portion of long-term debt, we have accounts payable and contract liabilities. I'm just going to assume that they're a percentage of sales. So once again, when something is a percentage of sales, 4, 17, and 9%, anything is a percentage of sales, all you have to do is go back to any one of these where the base formula was correctly used, and copy the base formula down, and then you'll have the correct number as a percentage of that year's sales. So I took whatever row I used for the base formula. Okay, I have those three current assets, and those are that's going to ensure that this number here is 4% of the 2020 sales, and this number here, the 2,687, is 70% of the 2020 sales, and the contract liabilities there are 9% of the 2020 sales, and also the same thing applies for the other years. I'm going to go ahead and D-line these things, take the line out, because your next number is your total current liabilities. And I'm going to go ahead and make that bold, and your total current liabilities is only 3. You have, I'll put in the equation now, this is equal to the current portion of your long-term debt. Then this is going to be equal to, it's going to be current portion of long-term debt plus accounts payable plus your contract liabilities. So your current liabilities should be, for the first year, 4758. I'm looking at my thing here. Okay, no. Do one thing here. I have a sheet I'm obviously working with. Now, there's nothing wrong with what I did. And I'm just going to go ahead. I'm just going to change this number, current portion of long-term debt. And this is actually probably a good thing I did. Let's make this flat. Let's make this flat. Sorry about that. I hope it don't mess you up. That's just the way life is sometimes, given all the events in the world now. But I'm just going to make this flat because we don't know. Long-term debt really has no relationship to sales, whereas accounts payable pretty much does. It's related to inventory, which is related to sales, and probably contract liabilities too. So if we make the current portion of long-term debt 600, then our total current assets at the end of the first year should be 4716, and we can just copy that across, and there's your total current assets going across. Okay, and so I'm going to go ahead and make these bold, and I'm going to do that for 2 reasons. I'm going to make them bold for 2 reasons. You'll see why in a second. Okay, so your total current liabilities are those numbers right there, and they do check with the sheet that I made earlier. Okay, now we're going to get to some numbers which are important, and I want to go through these somewhat slowly. We're almost finished here, actually, but there's a couple of things you have to do to make sure that your retained earnings are valid and that your balance sheet actually balances. And if you send me a balance sheet where the subtotals are not subtotals and where the balance sheet doesn't balance, you're going to get it right back. Okay, so anyway, long-term debt. Long-term debt. I'm going to compute this one way initially, and then when I finish all the statements, I'm actually going to recompute it. Okay, so here's how I'm going to label this. Right now, I'm just going to base it. Let's say I'm just going to base it on the base formula. By the way, let's get all these things done here for a second. Okay, so the base formula, I based both accounts payable on the base formula and contract liabilities, and I assumed that I assume the current portion of long-term debt is flat. Okay, now I'm going to assume, I'm going to go ahead and for the time being, I'm going to assume that long-term debt is based on the base formula. Now that doesn't make a lot of sense because it's a financing decision, how much debt you take out versus equity is a financing decision. It really doesn't have that much to do with sales. Indirectly it might, but more of a financing than operating decision. But I'm going to change that later. So here's what I'm going to do. Initially, it's going to be based on the base formula. So I'm just going to go ahead and copy that formula down. But then after I finish the statements, to get these statements to plug, what I'm saying, to get these statements to balance, I'm going to use that as my plug number. Okay, and there's a practical reason for doing this, and also a theoretical reason for doing this, and it's just an initial model. So I'm going to use that as my plug number. And by plug, I mean it's in order to get these financial statements to balance at the end, you're going to have to find some number to plug, and it's usually long-term debt. So for now, I'm just going to base it on the base formula. I'm going to get some financial statements that don't balance, and finally I'm going to figure out a plug number, and then I'll get the financial statements to balance. Okay, so since I'm basing it on the so-called base formula, I can just once again take any row for which I use my base formula and just copy that, and I'll get the correct percentage of sales. Okay, and I'll take that line out there. Okay, and so right now I'm assuming that my long-term debt started at 47.13 and then went up to 66.10. That's probably a not realistic way to look at it, but that's why we're going to come back when we finish the statements, and it'll be the last step to get these statements to balance. Okay, now income taxes payable, and other liabilities, which are non-current. I guess these are both non-current. I don't see them under current. They're under long-term debt, so they look like non-current. I'm just going to assume that those two things are based on the base formula. So here's what I'm going to do. Since long-term debt was calculated on the base formula, all I've got to do is copy the base formula down, and these numbers will be 9 and 3% of sales respectively. You can almost assume it. Okay, so now we get to your total liabilities. Your total liabilities are obviously a subtotal, so I'm going to emphasize here that subtotals must be subtotals, and so your total liabilities are a subtotal. By the way, your total current liabilities are also a subtotal. And then I also assumed, I'm just going to try to give you some hints as to what I'm doing here. Your base formula is used I use the base formula to compute, for the time being, long-term debt. It'll be a plug. But the base formula is being used to compute income tax payable under liabilities. Okay, so your total liabilities, I'm going to make sure this comes out, are going to be your total current liabilities plus your total long-term debt plus your income taxes payable plus your other liabilities. Okay, so let me just check my sheet here. So your total liabilities for the first year should be, let's see what I'm getting here. Your total liabilities for the first year, I'm getting a number that's too high here. Should be 4716. That's fine. That's good for now. That's good for now. They may have changed. Okay, so your total liabilities for the first year are going to be your total current liabilities of 4716 plus your long-term debt of 5043 plus your income taxes payable of 1364, other liabilities of 401. Keep in mind that your total liabilities will change because I'm going to change, in the end, I'm going to change the long-term debt from the base formula to a plug number. Anyway, I'm going to go ahead and we're going to total these across. And so your total liabilities are, I'm just going to go ahead. They're obviously subtotals. I'm just going to go ahead and highlight them there. And I'm going to underline these numbers here just to emphasize that total liabilities are a subtotal. And that should be a single underline. Okay, now we've got some equity is usually fairly easy. except for there's a little, we have to close out retained earnings, but I'm going to assume, here's your stockholders' equity. You got your preferred stock, your common stock. Look how small the par value of the common stock is. It's a cent. They have a lot of additional paid-in capital because the par value is so small. Take a look at retained earnings. Retained earnings looks normal, but take a look at your treasury stock. That's a negative. That's why ultimately you might make the conclusion that the company is actually using treasury stock in essence as a plug number by engaging in stock buybacks. But we'll see. We'll talk about it at the end. But I'm going to make this very easy by assuming that preferred stock, common stock, additional paid-in capital, I'm going to assume that these are all flat. Numbers are pretty small anyway, so I'm going to assume that these are all flat. Okay, so this is 1, 2, 3, 4, 5. Okay, so I'm going to assume that all those numbers there are flat, okay, which makes it easy. And there's no reason not to assume it, actually. The one you'd have to look at are the stock buybacks. Okay, so anyway, we're assuming those numbers are flat. That's good. Okay, now, here is the important number, retained earnings. And you got to make sure to do this. We're going back to accounting 201. Retained earnings is always a special number. Right now, we're going to assume 0 dividends. Okay, we're going to assume 0 dividends. You can almost assume 0 dividends. I haven't looked at their dividend payout, but they're not paying dividends. They're buying back treasury shares. Okay, anyway, so we're going to assume 0 dividends. So what we've got to do in retained earnings, your retained earnings is the one thing that's not flat from the base equation, or it's not a subtotal. In a sense, it is a subtotal, but not in the strict sense of the word. But going back to accounting 201, all we're going to do is say that retained earnings are your beginning retained earnings for any year plus your next year's net income. So be very careful with this. So these are going to be beginning retained earnings plus your net income. This is incredibly important. Okay, and so I'm going to put this, I'm going to actually make this really large. Beginning retained earnings plus net income. Okay, so your retained earnings for the year, we're working in the year 2020 here, going all the way up. Okay, so your retained earnings for the year 2020, we're going to really have to do a rather long entry here, but it's easy. There are your beginning retained earnings. Those are your beginning retained earnings. Plus, that's 2,000. That's the beginning retained earnings for 2020, which are the same thing as any retained earnings for 2019. And all we're going to do is take the beginning retained earnings and go all the way up to the income statement, and we're going to add this year's income of 2901. Okay, so we add this year's net income of 2901, and you'll get any retained earnings of 287 and something. Okay, and all you've got to do is copy the rest of these out. In a sense, they're a subtotal. These are a subtotal. And I'll go ahead and make these columns a little wider so that we can read what they are. Okay, and so we start with 27,000 and we end it with 41. So they're growing. Okay, now here's a number that I'm going to keep flat. So there's your retained earnings. And I should put those in bold. They're not, I'm not going to put an underline underneath them because they are not a subtotal, but they're very important. Okay, but keep in mind that the equation for retained earnings is simply the beginning retained earnings plus the net income all the way up here on your income statement. Excuse me, there's your net income. And so that's accounting 201 and just add it across. Okay, finally, I'm going to assume that treasury stock is going to remain consistent, is going to be flat. Now, that's a bad assumption. And I'm going to ask you a question at the end of this video, which I may throw on your grade somehow. But let's see what you get. It's really common sense. And I'm also going to assume that accumulated other comprehensive loss in this case, I'm going to assume that that's also a flat number. Okay, so I'm keeping treasury stock flat, and I'm keeping AOCL in this case flat. Okay, so initially I'm just marking these for you. I'm assuming that's flat, obviously, and I'm assuming this is flat, obviously. Okay, so I'm assuming that the AOCI is flat. Okay, now we go to your total shareholders' equity. Your total shareholders' equity, there's not many numbers in there, but your total shareholders' equity is going to be equal to some numbers that are pretty small. And I'm going to outline them all. Preferred stock, which is 0 anyway. Then I'm going to put in common stock, which has par value so small, it's almost irrelevant. Your additional paid-in capital, so wait a minute here, plus your additional paid-in capital of 75.95, plus the all-important retained earnings, plus or minus in this case, rather large share buybacks, plus small amounts of accumulated other comprehensive loss. Okay, so your shareholders' equity is 11,115, at least initially. And here's what we're going to do. We're just going to go ahead now. First of all, we know that shareholders' equity is a subtotal. So I'm just identifying which numbers are subtotals, which are based on the base formula, the percentage of sales, and which we're assuming are flat. Okay, so your total shareholders' equity is 11,115. What I'm going to do now is I'm going to go ahead and copy that number all the way across. Should differ because retained earnings are going up. Okay, and I will underline it because the next number is your subtotal. Okay, is going to be your total. The next number is going to be your total liabilities and shareholders' equity. Okay, so far I believe we're going okay. We'll find out in a few minutes. Okay, now the last number is obviously your balancing total. Total liabilities and shareholders' equity. So you should only have to take two numbers add two numbers to get your right-hand side total. Your total liabilities here for the first year are 11,525, plus we add to that your shareholders' equity of 11,115. So at least initially, your total liabilities and shareholders' equity is 22,639 or something like that. Okay. Now, since it's a subtotal, and I'm going to specify that is a subtotal, so I'm going to go ahead and say that's a subtotal. Okay, obviously, and all I've got to do is take that number, go all the way across, and it looks like we're almost finished. And I say almost finished because the important step is yet to come. Okay, so this is our balancing total. So our balancing total for the first year is 22,639, 26,514, 36,555, 35,113, and 39,878. Okay, so those are our balancing totals for the first for our years here. We have one problem though before we finish this though, and that problem is kind of important to accounting, is that you'll see that our total liabilities and shareholders' equity of 22,639. Let's look at the first year. This is 22,639. That does not equal our total assets of 19,845. And the same is going to be true for all the other years. You're going to see, let's say for the second year, this is 2021, you have total liabilities and shareholders' equity of 26,514. And if you go up to total assets for that year, here's the total assets, it's 2724. We've got a problem. As I used to say in the space program, Houston, we've got a problem. Okay, so, and that's why we need to consider long-term debt. This is our initial plug figure. Because of the way these things are constructed, and because some of the numbers were flat and all that stuff, the thing doesn't balance. Okay, so we've got to choose a plug figure. Okay, now the plug figure, it's mechanical, and it will let us, once we finish it, it will let us balance mechanically. But it also has a meaning. And so I'm just initially putting this plug figure here into long-term debt. But you could argue that it really belongs down in treasury stock with all those negative numbers. Okay, so anyway, so let's put it long-term debt now because it's kind of practice. But after you make some financial statements, and for our purposes, this is just keep it long-term debt. But you can see that essentially for this company, their plug number is that that negative number in treasury stock. Okay, so here's how we're going to do our plug number. What we've got to do is, and this formula is going to be very important, so I'm going to go through this slowly, but once we're done, we're done. Let me get my number out here, and let's pray that this works. Okay, so what I'm going to do is I'm going to give you a formula, and all I'm doing is basically taking the total assets, and I'm going to subtract out every liability or shareholders' equity. I'm going to find some way to subtract out every liability or shareholders' equity that is not long-term debt. And the result will give me a long-term debt number, which enables me to balance. So let me go through this very slowly. Okay, so let's start with 2020. Your long-term debt number, just using the base formula, is 5043. Okay, now, here's what I'm going to do. I'm going to replace that 5043. I'm going to replace it with the following formula. Basically, I'm going to take the assets, the total assets, and I'm going to subtract from that every liability or shareholders' equity that is not long-term debt. Okay, so there's my I'm going to take D47, which are total assets. Then I'm going to subtract out D52, which are my total current liabilities. So in essence, I'm taking out all the individual current liabilities. Keep going down here and keep track of the formula up here. Then I'm taking out two liabilities which were not subtotal to start with. I'm going to take out D54, which are my income taxes, which are my long-term debt, which my income tax is payable. But they weren't subtotaled, so I'm including them as a separate item to be subtracted. And finally, finally for the liabilities, finally I'm going to take out other liabilities which were not subtotaled, so I couldn't just take some subtotal like I did for the current total liabilities. So far I've got total assets less D52, which are the total current liabilities, which takes all those out. I'm going to take out income taxes payable and other liabilities. And the final thing I'm going to take out is I'm going to take out just total shareholders' equity. I'm going to take out total shareholders' equity because that includes everything in shareholders' equity. So I'm going to take out total shareholders' equity right there. So the final formula here in this particular worksheet is D47 minus D52, and I'll review this at the end, minus D54, so that's my total assets, less my total current liabilities, minus my income taxes payable, minus my deferred income taxes, and finally less D65, which is all my current or my total shareholders' equity, and I end up with long-term debt of 2249. And lo and behold, that works. How do I know it works? Because my total liabilities and stockholders' equity down here is equal to, and that's equal to, let me repeat that, it's 19,845. That is equal to my total current assets for the year of 19,845. I was able to do that through this formula right here. Let's see if I can look at the formula again. Anyway, I'm going to go ahead because this video is getting long, and I'll review this at the beginning of the next video, which should be a little shorter. I'm going to go ahead and just copy that formula for the plug all the way over here. And you may say, well, look, you're getting negative numbers. That can't be right. Your long-term debt is going down. That's okay. You can interpret that two ways. You can interpret it as they're paying off debt. You can also argue that those negative numbers might belong down here in treasury stock. Anyway, it should balance now. Okay, so if you look at the second year, my total assets are 20,724 and go all the way to the bottom. And lo and behold, my total liabilities and shareholders' equity are also 20,724. And then we go back and just to let's take a look at the last year before we finish here. Then for the last year, your total assets are 23,748, and your total liabilities and shareholders' equity are 23,747, 748. Obviously, there's rounding there. But anyway, that finishes this thing right here. And they actually have things like this on the CPA exam. It's getting more worksheet oriented, asking you, do you know what you're doing when you're putting together financial statements? This is a great tool for that. Consolidations are, as our statement of cash flows. Anyway, it's time to sign off because I think this thing's gotten a little long. I will review this at the beginning of the next video. And there I am. As always, please stay healthy. These are rough times. Please stay healthy. And good night and good bowling. Thank you very much.